Hello and welcome to TradingFloor.com's weekly commodities review. As 2010 comes to a close, commodities experience a soft recovery after year-end profit-taking. The debt crisis still lingers as a threat to stability, and as investors look towards 2011. And Ole Hansen gives us the final update on 2010 on crude, gold and silver on the Saxo Bank trading floor.
Hello, we are now well into December, and obviously the activity in the market is reflecting that as well. But if we just touch base on what's been going on over the past week here, we've seen continued strong performance from the stock markets. We're now back above the levels that we saw before the Lehman crash back in 2008. There is some worrying signs, and that's primarily from the bond markets, where yields are continuing to rise. Over the past couple of months, we've seen the US 10-year yield rise by more than 1%, and that's beginning to have an impact, and something that market is obviously a bit worried about. The European debt situation is still going on, and it's coming to and from going and coming from the front pages. And right now, this week, we've seen the Moody's putting Spain on a potential downgrade, and that's caused some focus again into this situation, and we've seen the euro weaken as a consequence. At the same time, we've also seen the Swiss franc reaching a new high against the euro, so obviously all is not well as we head towards the end of the year. And just to turn to China as well, we've seen them raising their capital reserves. They obviously got a very strong growth, and they have increased inflation, so any steps from them to reduce inflation is obviously going to be followed very closely in the year ahead. Okay, let's turn to the commodities this week, and if you look at the screen here, we can see that CRB index is only up by 0.6%. Activity is fairly quiet this time of year. The main increases this week so far is the soft section, which is recovering from the sell-off we've seen in the previous couple of weeks. Cotton is up 6.6%, sugar is up very strong 7%, coffee is up as well. If we move down towards the grain area, we've seen some increases there, especially from corn, but also soybeans rising a bit, while we've seen some profit taking in wheat. And if we move down to the energy sector, you see it's almost flat there on the week. And finally down the metals, copper is up, and we're seeing a bit of a rise there in silver as well. So generally a fairly quiet week. It's worth pointing out that according to Barclays Capital, they keep track of flows into commodities, and as of the end of October, they said that the total investor holdings in commodity was at a new record of $340 billion, which is way above the levels we reached when we had the last peak back in the middle of 2008. So the appetite for commodities is very strong here as we end 2010. Now let's turn to some of the commodities more in details, and if we look at the crude oil, we're here seeing the performance of the crude oil since January this year, and it's quite clear to see that we have primarily been trading at this $70 to $90 range, which has prevailed most of the year, and we're obviously finishing the year on a high. We're currently trading around $88.39. We still haven't managed to close above the important $90 level, which is viewed by many as a trigger for additional gains for later on into 2011. But right now, fairly tight range, which probably looks like that's going to prevail the rest of the year as liquidity is quite slowly drying out. The weekly inventories number, which were released early in the week, was actually a bit of a shocker. We saw the biggest draw in crude oil since 2002. There are some technical factors involved in this, but what it shows is the consumption growth has really returned with a vengeance here during the last quarter, and it's now actually the strongest for the past 3 decades. So that's one of the reasons why analysts are expecting a good start in terms of price rises into 2011. We have a very continued cold snap in Europe. The diesel demand in China has been strong as well over the past couple of months. That's helping drive these prices on the upside. And as I mentioned before, we've been trading in the $70 to $90 range for most of 2010, and there is currently the analysts are looking for an increase of $10 in that range. So we're looking towards the $80 to $100 range going into 2011. Worth noting as well that the speculative long interest is at a record high. That obviously is a little bit of a tricky thing if we should see any correction, because there are many investors positioned already, so that's something worth keeping an eye on. OPEC met at the weekend, and they made no change, which was expected. And we're now they're not meeting until June next year. But obviously, if need be, they can convene and make changes if the market dictates. But for now, we're looking at the resistance level at 90, and we've got support down towards the 87 level. So expect that more or less to hold for the rest of the year. If we turn to the screen again, we now just have a brief look at gold price, and we're obviously on track to have risen for the 10th year in a row. What's worth noting is we tried to move above $1,400 now a couple of times during the autumn here, and most recently was just a couple of weeks back. It's being met by selling, and it's not unnatural this time of year that there is some profit taking being locked in. But for now we have pretty good support right below the market, and 1370 and 1350 level, 1370 up here and 1350 here, probably will provide some support. What's worth noting as well is, despite we're seeing these small corrections here, the silver is doing very well at the same time. And normally silver can be a bit of a signal if there are deeper corrections or bigger moves coming in the horizon. But silver has had a phenomenal autumn here. It's really been outperforming very strongly. Just as an example, back in July, 1 ounce of gold cost 68 ounces of silver, and that is now all the way down to 47 ounces. So that's a 30% outperformance we've seen since the summer. The flows into ETFs or exchange traded products continues very strongly, and we just now reached a new record high in terms of sums invested in this sector. So again, investors are positioning themselves ahead for 2011, where the forecast is generally pointing towards higher prices. With just a couple of weeks left of 2010, it's obviously a good time just to have a quick look ahead towards 2011 and some of the expectations currently being thrown around the market. There is a general belief that the economic growth in China, despite rising interest rates, will continue to be strong. At the same time, the US economy is aided by all this quantitative easing, is also going to show some strength next year. So the expectation on that basis is that the cyclical commodities like energy and base metals will do quite well. Hence the forecast for oil prices potentially reaching $100 during 2011. It's worth pointing out at the same time that when we have the two biggest economies in the world fighting over natural resources, there might be some constraints there, and that this is really what led to the big sell-off we had back in 2008. That we had this commodity price shock because there's too much competition for the commodities. So that is a risk going into the second half of 2011. That if we see too strong a rally in commodities, we could have a price shock basically, which could have an impact on growth and also on stock markets. But we're expecting to see the rally as we've seen at the beginning of throughout the last half of 2010 to continue into 2011. Weather is obviously going to be very important. We had some adverse weather during the year, especially basically across the globe, and with agricultural supplies at low levels, that's going to be something that could have an impact again in 2011. And so finally, so basically we expect commodities to perform well in the beginning, but there is a risk that it could run ahead of itself and that could have an adverse impact later in the year.